The last 2 weeks have certainly got investors' attention, waking them from an extended dream of never-ending high returns accompanied by ultra-low volatility. But that's all changed. You're not the only ones who are scared. In fact, it seems like the capital raising market has turned off, with a couple of LICs having their IPOs pulled. Now, for more than 20 years, I've carried with me a market aphorism. To whom it should be attributed, I can't recall, but its usefulness has never been lost on me. And it's this: high interest rates aren't a problem until they are. In other words, the market initially approaches rising rates, especially ahead of the curve steady as she goes rate increases, as a sign that the economy is doing well. But as rates continue to rise, at some point, sentiment shifts from thinking about growth to the relative attractiveness of cash, or perhaps more accurately, the increasing dangers of risky assets. Now, that switch may have just occurred. On the back of a stronger US economy, real yields are rising too. US 10-year Treasury rates have risen to a 7-year high of 3.25%, but the real yield, adjusted for inflation, is now above 1% for the first time since 2011, and as the effect on real yields from an end to accommodative monetary policy begins to be felt, the impact will be meaningful. As rates rise, particularly real rates, the cost of capital and risk premiums increase across the economy, impacting all asset values and the attractiveness of investments and projects. But it's essential investors understand what is impacted most adversely. The worst effects from higher real rates are always reserved for long duration assets, those growth investments with their cash flows backdated. What do I mean by that? Well, think about some of those profitless companies like Xero and Afterpay, whose shares have rallied amid a chase for business and share price momentum. The value of those businesses comes from earnings that are yet to materialise, yet they're earnings that may not materialise. By way of example, let's take Afterpay. From its opening price this calendar year of $6 per share, Afterpay rallied to more than $21 by the end of August, with the company signing up thousands of customers and thousands of merchants and hundreds and thousands of customers, and rolled its offer out into the US and the UK. But in just 6 weeks since the end of August, Afterpay has fallen by more than a third. And Afterpay still makes no profit and trades on a market capitalisation of $3.2 billion, which is 44 times forecast 2020 NPAT, provided NPAT grows that year by more than 300%. From experience, I know that in situations where high expected earnings growth doesn't materialise, share prices can fall 50 to 80%, and it's not uncommon during market dislocations. Fortunately, the Montgomery Fund has not chased these higher beta stories. Believing value to be an essential but missing element in these opportunities, Montgomery has instead been holding a relatively high level of cash. And in the first 2 weeks of October, that cash has certainly helped. As this chart illustrates, in just 2 weeks, while the market has fallen 6%, the Montgomery Fund has added 180 basis points of alpha. That's all we have time for in this update.